We are.
Hey guys, welcome to Monday's market update and call. We got a lot of stuff to talk about today. As far as what we're going to be talking about, as far as terms of the market, not really a lot has changed, right? So really from where we were about 10 days ago, we really haven't moved anywhere. We have moved way down and then we have moved way back up, but we kind of ended back in about the same place. So just a real quick recap on the market. Last on 2-3, we were about 450 billion. The market dropped pretty harsh through February 6th for about 3 days, mainly because of fear, uncertainty, and doubt. So the uncertainty was caused by this massive Senate hearing where the SEC and CFTC were going to appear before the Senate, caused massive uncertainty. Because of the uncertainty, there was fear and doubt, and people were willing to pay less for the product, right, at that time. So we saw the market drop from 450 billion to 276 billion, a 40% drop, which was massive. 40% drop in a couple of days is massive. It crawled back up on the Friday's market recap. We talked about that, got up to about 425 billion or so. And that's where we find ourselves today. So really not much has changed over the weekend. Like I said, we find ourselves back to where we were on 2-3, but it was volatile. It went down and it went back up. Now, because I am looking at this market over a very long-term basis, I don't get concerned. I mean, obviously I'm affected like anybody else where like, I don't like to see it going down. I check my balance and it's down. I don't like to see that. But even if it doubled or tripled tomorrow, I'm not going to sell. And likewise, if it drops in half, I'm not going to sell either. So, I'm looking a year from now, 2 years from now. Some of these I'm looking 5 years from now. So whatever happens over the next couple of weeks doesn't really concern me. Like I said, I'm not immune, and I don't like to see it, but right, I have my eyes focused much further out. Hopefully you do as well. So anyway, that's kind of the quick market recap. You have anything to say about that, Dr. V?
No, I totally agree. I mean, we've talked about this all the time. And hey, good morning, everyone. We talk about this all the time. It's a long-term play. And if you're trying to jump in and out of this market, good luck if you have the stomach for it. It's a long-term play. So as you said, Mark, if it doubles tomorrow, I'm holding. If it falls tomorrow, I'm holding. So hopefully you bought on the dip if you had the means to do so. Yeah.
Now, there will be a time to get out. And it's going to be important to know when that time is going to be. And we are going to be talking extensively about that as we get nearer to that time. Right. I believe that it's impossible to time the markets, and not just what I believe. I mean, facts prove that.
That's correct.
So we can't time it, but what we can do is we can understand the signs that we're looking for, and we can pay attention for those signs. And those signs will start to tell us when we're nearing a top or nearing a bottom. We can't time it perfectly, but we can work around that. So there will be a time to get out. That it's just not that time. We're not there yet. Interesting fact: I was listening to some interviews with Ray Dalio, and Ray Dalio runs a fund called Bridgewater, and he's probably the most successful fund manager in the history of the world. I mean, he's made more money than anybody. And he's written a book, and it's Successful Principles. And he was talking about how over the last 20 years, the markets, the stock markets have averaged, I think he said 8%.
Right.
8% over the last 20 years.
Yeah.
If you would have missed 10 days of trading over 20 years, your returns would have dropped to 4%. If you would have missed the 20 best days out of 20 years, 20 days out of 20 years, your returns drop to like 1%. And if you miss the best 30 days out of 20 years, you're losing money. And so the reason why that's important, and that really struck me, is just to emphasize the fact you can't time this. And so a lot of times, things are volatile. And so because we can have that long-term perspective, we can make sure, and you guys can see like how fast these things bounce back, right? Like if you sold out at 450 and you thought you're going to buy back in at 300, well, if you missed it within a couple hours, like I was at work, I was at the mall, whatever, within a couple hours, it's too late. And
Right.
so what he was saying, what Ray Dalio was saying is that actually the best days, those 20 best days they're talking about, happened exactly after the 20 worst days. So, and psychologically, we talk about this a bunch, right? Psychologically, it prevents you from being successful in these markets because it works against you. So to reiterate that fact, if you would have bought in on February 6th at 276 billion, you would be up 50% in less than a week.
Right.
Now, a lot of you guys, we had raised the buy up to on NEO from, $5 to $25, $35, $100, and it recently just passed the $100 mark, like within a few weeks ago. Then it crawled all the way up to like 200, and everyone's like, "Oh, is it too late? Can I still get in on NEO? Can I still get in?" It's like, well, it was just under the buy up to. Now you want to get in, right? Well, NEO dropped to $64,
Right.
but nobody wanted to buy it at 64.
Right.
Oh no, it's gonna crash. I don't want to buy at 64. It's probably gonna go to zero. Well, if you would have bought at 64, you would have made almost 100% on your money already in a week.
Right.
100% in a week. So, psychology works against us. That's why our the way that we look at the market and what we're doing is we're looking long term. So we're just gonna ride that out. We're not trying to get out and get back in. We're just I'm watching it go down. I'm watching it go back up. Right. So.
Yeah. Mark, what I found, did you catch the news? There are quite a few stories about people pegging Bitcoin to gold and trying to figure out whether there's a correlation there. I find that conversation very interesting because it tells me, and there's some large large banking houses looking at this research, conducting this research. I think that's very promising because I think after the congressional hearings, I think we can all agree that the regulation in this space is not going to be as aggressive as people think. So I think institutions took note of that, and now institutions are trying to figure out how to correlate changes in Bitcoin and cryptocurrency with the overall market. I think it's a promising sign. They're putting a lot of money into this research as they anticipate entering this market. So it goes back to what we've been saying for a while. Once that institutional money comes in, it really changes the game.
I would like to know, well, first of all, there's massive differences on correlation and causation.
And causation, yeah, that
So,
absolutely.
To be determined. And then we want to look at who is doing these reports?
Right.
What is their motivation? Are they pro Bitcoin or are they pro?
Right.
Right. So there's there's a lot more to that. But what I would say with my surface level, I mean, I'm not really caught up on this topic specifically, but I would look at those two things. But what I would just say is that Bitcoin is digital gold.
Right.
Everybody calls it digital gold. That's what it is. I believe that Bitcoin is a good store of value. And so actually what's interesting is in this interview, they asked Ray Dalio what he thinks about cryptocurrencies. And he had a very intelligent response. I was actually surprised because you hear what Warren Buffett says and stuff like that. But Ray Dalio actually looked at it really good. And of course, he's the best money manager in the world. But he talked about money or a currency. And there's two aspects of a currency. One is an exchange, a medium of exchange, but the second is a store of value. And so we, the people against Bitcoin, what we've been hearing for the last year is that Bitcoin isn't a good currency because transactions are too slow, they're too expensive. Right. So it's not a good, medium of exchange, but it is an awesome store of value. And I believe that's really where the value is. And that's why they compare it to gold, because why do you hold gold?
Right.
I personally hold gold. Not only do I hold physical gold, I also have gold stocks. Like in miners and whatnot. And I believe it's important to be diversified. I love gold. I've been involved in gold in a long time, but I'm in gold as a store of value. And right. So what happens is as they continue to inflate dollars, they print more dollars, they inflate it, then gold is a hedge, right? But I've never tried to grab some gold out of my safe and go to Starbucks.
Right.
So it's not a good medium of exchange, but it's a store of value. So if Bitcoin is a store of value, if it is digital gold, then it would make sense that people that own gold would probably diversify some of that gold holding into Bitcoin. And the gold market is somewhere between $7 and $8 trillion. So just the gold market, $7 to $8 trillion, where Bitcoin's like 200 million.
Yeah.
or no, sorry, like 200 billion, right?
Yeah, 200, it's like 200 billion.
sorry, 200 billion. But still, so it's actually 146 billion, versus the gold market being 7 and 8 trillion. So what I believe is that if gold is digital, or Bitcoin is digital gold, which I think is a good comparison, then I believe that we're going to see a massive amount of people that own gold for the hedge diversify part of that into Bitcoin. And so even if 10% of that were to come over, 10%, which is very likely, 700 million into 146 million market cap.
Yeah.
I think there's B, Mark, not M. Billion.
Yeah, you can say a million.
Yeah.
Billion.
I can't get my head around those big numbers.
Yeah.
Hey, yeah, I think there's that. I think that's a good analogy. I think we should also consider a collapse in the U.S. market would also be highly contagious. I expect to see a global sell-off, a significant global sell-off. And I believe that store of value in cryptocurrency will basically translate to significant upside.
The thing is that the interesting thing about that, though, is so what you're saying is that, or people are saying that there could be some correlation, possibly causation. And for those of you guys that don't know, correlation means that, like, hey, when gold prices rise, Bitcoin prices rise. Look at that. Oh, when gold prices drop, Bitcoin prices drop. So that's called correlation. They're correlated. They're moving together.
Right.
But that doesn't necessarily mean that's the cause or the reason. So that's what we're talking about for those of you guys that don't know.
And that's what's missing in the research. You know, I always look for causation. They'll talk about correlation. Things can correlate. There can be a pattern, and that pattern can be short term. If we don't understand the causation behind it, then it's sort of fruitless, meaningless. But yeah, totally.
Exactly. So that's what we're talking about, guys, for those of you who don't know. But we can look at gold to the economy. So now, Dr. V, you're talking about like a global sell-off, right? So now this is like a much bigger topic, and we're talking about, you know, the stock market crashed pretty hard. We know, like, the banking system super fragile, debt levels are elevated, super high. So we understand all that. So what happens in a market crash? Now, typically, and we don't know with cryptocurrencies what's going to happen, but we do know what happens with gold, because, you know, that's been around for hundreds or thousands of years, so we can study that. So what happens is typically people go into gold as a hedge against the inflation. So what happens is with our dollars, you know, they push a button and there's an extra $1 trillion. And every time they do that, your dollar's worth less. Your purchasing power goes down. So that's called inflating, right? Like, imagine like a balloon. And there, as more dollars are printed, it inflates the balloon, right? The balloon gets bigger and bigger. And so as that balloon gets bigger, as the inflation happens, my dollar's worth less. So I go into gold to hedge against that.
Right.
And so gold's rising, but we also see the opposite correlation and, I believe, causation, that when markets crash, money disappears and they deflate. And under deflationary times, gold will go down in value. So typically inflation causes gold prices to go up, deflation causes gold prices to come down. So I don't know what we're going to see. Is it going to be inflation? I would say that we will probably see, as the markets crash, we would see massive inflation to try and save it before we see the massive deflation. So I think we're going to ramp up and then come down.
Yeah, and if you look historically, that's usually what happens with this, and that's people's argument against the Federal Reserve. They pump so much money into the system to try to get inflation up, and then it starts to run away. So it's such a slippery slope right now, but it starts to run away, markets start to crash, and then they have to catch up, and then we hit deflation when they tighten. So I just very interesting times right now.
So there's two different schools of thought, right? You have the Austrian school of economics and you have the Keynesian economics, right?
Right.
And they're different. And
right.
Personally, I believe in the Austrian school of economics. I don't think we should have ever gotten as far as we have, but we are where we are. And
with stimulus, you mean?
With the Keynesian style, right? The stimulus, right? The unlimited credit expansion.
Yeah.
I believe that markets ebb and flow. And corrections are important because we're constantly trying to find that medium. And what happens is that this intervention that has happened has created a monster. And what happens is eventually the market you can't beat the market, but you can manipulate it. So what happens is the further we manipulate it, the worse it's going to be.
Right.
So if we would have let the 2008 correction run its course, it would have gotten a little bit worse, but we could have reset. Well, we didn't. We put that sucker on life support, and I believe now, unfortunately, the next correction is going to be that much worse because of that. It's kind of like
that's what leverage does. It just magnifies everything.
Hey, guys, let's just frame it first, right? Because I think we've jumped into a different topic, and I'm not sure if the audience is following us.
Okay.
So to frame things, we've now gone beyond the crypto markets, and now we're talking about general equity markets, general fiscal policy, and monetary policy. And I think this is an interesting conversation. So I'm going to start with a postulation, and maybe Mark, then you can give some background, or Dr. V, you can give some additional background. My personal opinion is, and Mark's alluded to this, from 2008, we're kind of in the seventh inning stretch, maybe even further along in terms of how all this stuff comes into play. Now, let me just throw that out there. And Mark, I don't know if you want to run with this ball, or if Dr. V, you want to talk about this, why don't we frame it this way, and then eventually we'll tie this back into crypto or some of these other markets that we're talking about. So Mark, are we in the seventh inning stretch?
Yeah, I think we are, but as I've continued to say over and over and over, it's impossible to time.
Yeah.
So, and actually, let's define this too. The seventh inning stretch for which market, right? Because different markets are in different phases.
They are. The problem is that, and so you're right. Different markets are different phases, and so that's why guys like Ray Dalio, the best money manager in the world, they say the number one success principle is asset allocation. Knowing, being in stocks, being in bonds, being in securities, all those different things. The problem is that, markets are starting to, what one of the guys I follow and trust, he calls the melt up. We're in a melt up right now, and it's a melt up before the melt down. And the melt, so everything's starting to melt together.
Right.
And it's all starting to move together. So markets aren't, because of what's been going on with the monetary policies, like I said, we've created a zombie, and it's on life support, and it's not working like traditional markets have always worked. So you got to be aware of people who are always saying, well, over the last 50 years, this is what's happened. Well, we're going into uncharted territory.
Right.
So whatever the history is over the last 80 or 100 years is not going to be what's going to happen. So we've created this zombie, and now we're in this melt up where everything's moving together, and eventually we're going to have the melt down where everything's coming down together. So so to answer that, Charles, yes, I think we're like in the seventh or eighth inning, meaning we're getting to the top of what that melt up is. Now, bubbles are the most frothy at the top. So everything's a bubble, but are we at the beginning of the bubble or at the top of the bubble? And it's always that last bit of the bubble that moves the fastest, right? So that's my opinion. But as I always say, nobody can time the markets. We're looking for signs, and that's what the signs are telling me. So I don't know. I hate to put a time frame on. I'm really no expert in this. I find it fascinating. I study it, but I'm definitely no expert on this. But potentially we have another year, 18 months, I think, maybe before. But I've been expecting it for a long time. So.
Yeah, I don't think let me just add to that, Mark. I agree with what you're saying. It's impossible to time the markets. So anyone that even, it's a fruitless activity. It's impossible to time the markets. That's one. So then we talk about the importance of diversification. Diversification is important, but there's a problem with diversification. Diversification only works when markets are going up, because markets fall together. When there's a crash, everything's moving down. For the most part, assets start to move as a one. The correlation goes closer to one across those allocations. So it just doesn't work. So when Mark talks about, for instance, crypto being a long-term play, cryptocurrency being a long-term play, that's true. We are holding it for the long term, but there is a time where you have to get out. There will be a time to liquidate, to reallocate. And that's why, research products like Jarvis are important, because if you can't do that on your own, I do it a lot for the equities markets. I do that for clients who don't understand the equities markets. It's the same thing for crypto, and it's an even newer market. So there's a lot more to wrap your head around, as we'll talk about a little later on. We're going to talk about these token mechanics. It's not straightforward. This market doesn't look like the equity market that we're all familiar with, where there are cash flows and we can look at hard fundamental analysis, and things should either make sense or they don't. It's very new. It's a very new space. So
the other thing is that we talk about, you said equity markets, right? We're talking about the stock markets. We're talking about treasuries, bonds, whatever, right? That's all U.S. It's all U.S. based, right?
Right.
Crypto markets are global. So it's a whole different animal. But ultimately, I would say we're not trying to spread fear.
No.
That's the last thing we're trying to do. We're just trying to give you an understanding of what's going on. Don't take this as bad news. Don't take this as fear mongering. We're just trying to fill you in. I believe that this year is still going to be the biggest boom that we've ever seen in any market. I believe it's going to set records globally. So I think that's going to happen. Now, what's going to happen in 2 or 3 years? I think we're going to have a long, cold winter. I don't know when, but history tells us we're going to.
No more winter, Mark. No more winter.
Yeah. So I'm curious. So I'm going to go out on a limb, right? Because it's always tough for someone to go out on a limb. And I'm going to apply our, call it, baseball analogy. I believe personally, and I'm going out on a limb because I obviously want you guys to criticize or offer opinions or feedback. I believe in certain markets, specifically U.S.-based treasuries and equities and stuff like that, we're probably closer to the 7th inning stretch. Maybe we're going to the 8th inning. We might be going into a little bit of overtime. I would make an argument that for housing, we might be, 6th, 7th inning or whatnot. And then for certain commodities, we might even be an earlier stage. And given the nature of the developing world, I might make a case that, your crypto markets are in the 3rd or 4th inning. Now, that being said, we also have that secondary thing where everything is going to accelerate over the next 3 years. So I'm just putting that out there, and I'm curious to get both of your opinions, on that postulation, because I think one thing a lot of people think is they look at everything as one box, and the reality of asset allocation and all this sort of stuff is you've got a lot of moving parts, and all those come into play.
You want to go?
Well, I mean, yeah. Yeah. I think that's exactly what we've just been saying, right? I called it the 7th inning. Are different markets in different innings? Potentially, but what Dr. V and I are both kind of agreeing on is that I think we're in a melt up where I think we're starting to see the markets start to move together a lot more than they have in the past, and they should. So although, I guess I agree with the first part you're saying, Charles, that some is in the 7th inning, some maybe in the 4th. I think we've kind of melted together, and we're going to everything contaminates everything now. Right?
Exactly.
It's a global pandemic.
Exactly.
So, unfortunately, nothing is immune anymore. And we saw that in 2008, but what's going to happen next is going to be much larger than that. So
you said you mentioned, Mark, that this is a global market, not a U.S. market. But if you look, you're absolutely spot on. Excuse me. But I think if the U.S. market tanks, like you said, there's contagion. There's this feedback mechanism, right? Where if the U.S. market tanks, everything's going to tank. We're not the only country in significant debt. I mean, we are not the only country in significant debt. There is risk. There's global risk in this significant global risk in this system. And so we don't know for sure. Clearly, we don't know for sure. If we did, we wouldn't be here today, if we knew for sure. But I believe that the central bank system has inflated this market global. Now I'm talking global. Central banks have inflated our equity markets, meaning global equity markets, so much that when this thing falls with the massive debt we haven't seen debt. This is unprecedented. Okay. When this thing falls, we are so highly leveraged that I think real estate, everything's going to be impacted, right? So what is not tied to this central banking system? What is not tied to all of this leverage? This is why I believe in the long-term play and viability of cryptocurrency. People are going to run. They're going to lose faith if they haven't already done so. They're going to lose faith in the central banking system because they're going to see time and time again, it creates these massive boom bust cycles that screws the average man, that screws over the average working individual. While the bankers are going to come out on top. They're getting massive bonuses right now. I don't know if this is really not being talked about quite as much, but they're getting massive bonuses. They're raising the pay off of this false pretense of tax cuts. And this is going to be, I won't even go there. But I think this one's going to hurt. You know, you talk about preparing for the long winter. I think this one's going to hurt. And I think it's going to be too late as usual, because, you know, the average working person is working. They're not managing their portfolio. They're working. And so when it tanks and they lose 40, 50, whatever it's going to be % of their life savings, they're going to say, I can't do this anymore. And where are they going to look? Things that aren't tied with the central banking system. And that's going to be crypto. That is my humble, I could be wrong. This is my humble opinion.
We know that, I mean, Bitcoin was created for that
reason.
For the 2008 crash. That's the entire reason Bitcoin was created by the cypherpunks. That was their mission. Decentralized money, get us out of that, you know, that inflating banking system. So that's why it was created. And so I agree with you, Dr. B. I think, you know, as people see what's going on, they're going to want to continue to move in there more and more. So, you know, at the same time, you know, we're talking about this pending crash whenever it happens. The world doesn't end.
Right.
Move on.
Right.
We have crashes.
We didn't think we would. I mean, that was terrible. We came back from that, and we always come back.
Yeah. So you lick your wounds and you come back. You know. So yeah, it's not the end of the world. We're just talking and not trying to scare you guys, but just kind of fill you in on what's going on and what we're paying attention to.
Yeah. It's again, we're not here to instill fear. But knowledge is power. And if you understand how the markets work and the mechanisms behind the markets, you can make better and informed decisions. So someone like me, I'm a little younger. I still have, 10, 20, 30 years to be invested in this market. I'm not overly concerned. I do allocate my capital as I see, I won't tell you when I'm starting to move things to cash. Because I don't know when it's happening. I don't know when it's going to happen, but it's coming. It is coming.
The problem is, I mean, if you want to just keep going deeper and deeper, is that you're moving to cash. You're going to dollars. Well,
right. No, wait, no, I know. Right.
The dollar is jacked up, and the dollar's fate is written. The thing is that as bad as the dollar is, it's the prettiest girl at the dance. Right? That's
exactly. So we can crap on the dollar all day, all night, but we're not Venezuela. We're not, we are still the best looking currency in the world. So
the one thing I'll point out, and only because I just want people to kind of get a different perspective, is that. So going back to history, I've told this story before. I'm going to go through it super quick. But going back through history, right, you have the Romans and the Roman Empire. They want to take over the world. And the Roman Empire had a silver coin, and it was 100% silver. And they needed more money to continue their empire expansion. And so they didn't have any more money. So they took 10% of the silver. They meant 90% silver now, and they could make 10% more coins, 10% inflation. Now they had 10% more money, and they could expand their empire. That wasn't enough. They went to 80% silver. They expanded their money supply 10% more, expanded it over 200 years. After 200 years, they had 10% silver left in their coin. They had expanded their money supply by 90%. Well, basically, that's what the U.S. government has done. In 1970, they got off the gold standard and they started to expand the money supply. What the Roman Empire did in 200 years, we've done in 40 years. And so we've lost over 90% of our purchasing power. And the reason why that's important is if you understand in 1960, okay, so you need to kind of, just like we're trying to reframe our thinking, like where we're looking at prices in Bitcoin, we're used to looking at everything in prices of dollars. So you say, shoot, man, that house in 1965 was $30,000 and today it's $300,000. The price of the home went up. No, the price of the home did not go up. It takes more dollars to buy the home. So for example, what you do is you go in 1965, the average home was $50,000, let's say. In 1965, the medium home was $50,000. At that time, you compare it to other currencies. It took 200 barrels of oil. It took 3,000 ounces of gold. It took whatever, right? And you compare that in 1965 to oil, wheat, gas, gold, whatever, right? Well, today, now the price of the home is 300,000, but it still is the same amount of gold, the same amount of oil, the same. When you take these other commodities, the baskets is still the same. It's dollars that have gone up. So what's happening is it's not that the price of your home, cars have gone up. It's that your dollars are purchasing less. And the reason why that's important, and maybe like a little mental mind thing, is that are cryptocurrencies going up or are the dollars continuing to slide? And if you look at this, and I would ask any of you guys to do this because it's super cool, just go to Google and type in gold prices, like 100-year-old gold prices, and you'll see from like 1800s all the way until 1970, for like over 100 years, gold was 32 bucks an ounce. For over 100 years, 32 bucks an ounce. Today it's 1,300 an ounce. Right. Did gold all of a sudden go from 30 to 1,300? No, it just takes more dollars to buy that. So that's kind of the thinking.
That's a great point, Mark. And I use this analogy in class. Let's assume that there are only $10 circulating in the loanable funds market, in the market. There are only 10 units of dollars, right? If I own a home, I can't charge $20 for my home, right? There's just not enough capital. There's just not enough money in the market to absorb that price. But as the Fed keeps pumping additional supply into the market, then what can happen? Now there, instead of $10 in the market, now there's $1,000 circulating in the market. Now I have the capacity to charge $20. Not necessarily because there is an increase in value in the underlying asset. My home is not earning me higher rents. Maybe it's not. It's because there's more money. So now we can inflate prices. And this is what Mark is talking about when he talks about inflation. By putting more money, the system is problematic. And it's problematic, and it's all the more problematic when you keep this stimulus policy in play for too long, because then the markets start to go up rapidly. And when they fall just as rapidly. And we also know that markets fall a lot faster than they rise. So yeah. Go ahead, Mark.
Yeah, I agree. What I was saying is important to look other than just prices in dollars. So you look at things priced in other commodities.
Yes.
Like gold or whatever type of commodities. One just super like easy, cool kind of comparison is that for those of you guys that don't know, before 1965, dimes and nickels dimes were made out of real silver.
Yeah.
And now they're not silver, obviously, anymore. So if you can collect a pre-1965 dime, that's real silver. Well, before 1965, you can get 1 gallon of gas for about a dime.
Right.
Today, a gallon of gas is $2 or $3, right?
Right.
Well, a pre-1965 dime will still pay for a gallon of gas because it's pure silver.
Right.
The amount of silver in a 1965 dime will still pay for 1 gallon of gas today.
So just to add to this, seems like I've had a good, I guess I have a natural talent for instigating things, people riled up. But the interesting fact is, if you actually go back to what a Roman centurion's pay was back in 20 AD, and you compare that, backed against either the price of silver or gold, and then you compare what the dollar pay is of a captain, which is the equivalent in the U.S. Army of what a Roman centurion was, it comes out to the equivalent of around 55. I think it's like 50 or 60 grand a year, which, it becomes really, it's kind of a fascinating, it's a fascinating way to look at what Mark just said. Look back in the future, look back in the past. Our dollars are what our dollars are. We're not actually making wealth. We're just printing more money. So
and that can actually be a perfect segue, although we're running short on time, so maybe we're not going to get into it. I was going to say it could be a perfect segue into token mechanics.
Yeah, let's talk about that. I think we've got a few minutes to just.
So we had you and Charles made a statement about Ethereum, right? So Ethereum uses Ether to pay for transactions, and if Ethereum goes up in value too much, then it's too expensive to pay for transactions. But that's not the case, because they can change what it's pegged to.
Right.
So they know that they want to get approximately, X amount of dollars for that transaction. Well, today Ethereum is $1,000. Well, when Ethereum's $20,000, they're just going to take less percentage of a right. So they're pegging it to something. They don't tell us what it's pegged to, but they're pegging it to something, and that amount will change, kind of like what we're talking about with silver. The amount that they had it pegged to was enough to pay for basic living expenses, your house, your food, your whatever. And as the money changed, it's still pegged to that base, so it just changes the amount.
Right. It's the same concept. I hate to go back to equities. Charles is going to kill me. It's the same. It's the same concept of a stock split, right? Nothing is really happening with the why does a company split a stock, right? They split a stock to make it more affordable for people to buy the stock, right? So you muted yourself, Mark.
I said, or to get the CEO a big bonus, but
both, right? So people sort of have an issue with paying maybe $300 per share. But if I do a 6-for-1, or if I do a 2-for-1 or a 4-for-1 of $100 share, and it's $25 per share, just fundamentally, mentally, people feel better about spending $25 versus spending $100 per share. So it's all manipulation. It's all like you said, the mechanics of it to make people comfortable using that underlying currency.
Yeah.
But Dr. V, Litecoin's only $100, and that's so much cheaper than a Bitcoin.
So yeah, well, yeah, I guess it's all relative, right? Depending on the market. But that's why we do stock splits. Nothing has changed with the operations of the firm. They haven't invested in a new project. It's really just to make the per share price more obtainable for the average investor. And it's the same thing here. That's exactly what will happen. The Ether token, so if it goes up too high, then they'll change the ratio needed to service your app, so you're spot on, Mark. I agree.
So let me ask a question, and I'll ask Mark this question. We can dive into it. I think the fundamental, not a fundamental, but an important question to ask when buying into any sort of cryptocurrency or a token project is the question of what the heck am I actually buying? So I'm going to switch it up a little bit. Let's not talk about Ethereum. Let's talk about Neo. And I think Neo is an interesting one to talk about because there's actually two different tokens in the Neo network, or whatever, the Neo project or the network or whatever. You have Neo, the Neo token, and then you have the Neo gas token. Let me throw this over to Mark, hot potato. There you go. When I buy Neo, what do I get? When I buy Neo gas, what do I get? You want to start with that one, Mark?
Sure.
And maybe we start with how it works, and then we can just kind of, Dr. V, we'll have you play like, new person, because I know you haven't read the Neo white paper. So yeah.
So to answer that question, we have to back up a little bit. So Bitcoin was the first blockchain company, the first cryptocurrency, right? And the way Bitcoin works is that you have miners. And these miners, they buy this very expensive mining computer, they hook it into the blockchain, and they run calculations to, one, create more Bitcoin, and also process the transactions of the network. For doing that, they earn coins, right? So it's what we call proof of work, POW. So mining, as we know it, and I'm going to make this very simple. It gets more in depth. So if you're super technical, don't try and call me out on this, but I'm going to break it down for everyone to understand. So it's POW, proof of work. I'm doing work and I'm earning rewards. What we're starting to see now is a shift to what's called POS. And POS is proof of stake. And what that means is that by owning the tokens, I can stake them. That means I'm taking them out of circulation, and those tokens are now helping to process the transactions. And for doing that, I earn rewards. Just like a miner would earn rewards, my tokens can earn rewards. So we're seeing a shift from a POW, proof of work, to a POS, proof of stake. The reason why that's important is because NEO and Ethereum are completely different. Ethereum is a POW, a proof of work. NEO is a POS, a proof of stake. All right. So that's the big difference. And so to answer this question for Charles, we have to step back and understand that. So Ethereum is a proof of work. So there's people with computers, they're hooked up, they're processing transactions, right? So when I own Ethereum, I'm owning the Ether token. And as we've just discussed, the Ether token is used to process transactions. So Ethereum is a platform. This phone is an Android phone. Android is the operating system, it's the platform. On the Android, I have apps. I have an app store, and all these apps are built to run on the Android platform. Those apps have to pay to run on the platform. They pay in US dollars, most likely. Well, Ethereum is also a platform, and there's applications built on Ethereum, and those applications have to pay Ethereum to run, but they don't pay with US dollars. They pay with Ether tokens, which is what you and I are owning. Okay, so when I own Ethereum, I own the Ether token, which is used in transactions. That's all. Now, NEO is a little bit different, and it's a little bit more complex. So when I own NEO, I'm not owning their gas token. So we call the Ether token, we call it gas because they're paying to run on the network. So when I own Ethereum, I'm only owning their Ether token, their gas token. When I own NEO, I'm not owning the gas token. When I own NEO, to run on the NEO platform, the apps that run on the NEO platform don't pay in NEO, they pay in a token called gas. So NEO actually has two tokens. They have one called NEO and one called gas. The apps that run on the NEO platform pay with gas, not with NEO. So then you might ask yourself, well, then what the heck do I own NEO for? Right? If gas is what's needed to run the network, why do I own NEO? That's a great question. I believe gas is way underpriced, and I believe that we're going to see gas prices rise to be a NEO. But back to the question, why do I own NEO? The answer is because NEO is not a proof of work like Bitcoin and Ethereum. NEO is a POS, a proof of staking. So by owning NEO and staking it, by taking it and holding it, I earn dividends. I earned gas tokens. So that's what I was talking about. So in a POS, I stake my NEO and I earn gas tokens for owning NEO. In addition, I get a vote. You know, if I go up to a node, I get a vote on the governance of NEO and blah blah blah. But to keep it simple, with Ethereum, I'm just owning the gas token. With NEO, I'm earning rewards of their gas token, which I can own separately. Does that make it simple enough?
I think it does, but I'm going to want to dive a little deeper because I think a lot of people, I think we have a very educated audience. So I'm going to dive deeper and just kind of ask some, I call them basic questions, but questions. So as I understand Ethereum, Mark, with Ethereum, because I earn Ether tokens, if I look at like how the entire token allocation has come up, right?
What do you mean you earn Ether tokens with Ethereum?
Well, yeah, exactly. I'm stepping back, so let me kind of explain. So currently in the Ethereum network, there is a bunch of tokens that have been produced. Or let me take that back. That's even, let me step back again. There is a total supply of Ether tokens that has been decided upon. Of the total supply of Ether tokens that was decided upon, there was some percentage that was sold off to the market as part of the pre-sale. And that today is, quote unquote, the majority of Ether tokens that, you might own or I might own or that we trade, on the market side. In addition, there is a set aside of Ether tokens for people who want to become Ethereum miners. And what a miner does is I dedicate some sort of hardware, some processing power, some sort of manpower, just all these resources so that I can help build up the Ethereum network. And if I run, as compensation for running the Ether node or the mining node, I have the option to either mine for more Ethereum, so that kind of covers me in the short term. And as the Ethereum network gets busier, I can process Ethereum transactions and be paid in Ethereum.
How are you going to process? What you mean as a miner?
As a miner, yes, as a
Right.
miner.
POW, right? That's what I explained.
Correct. That's how that works. So now that makes sense. Now, if I move over to the Neo world, all I need to do is own Neo tokens to get, proof of stake. Why would anyone ever build a Neo mine, a Neo node?
Oh man, that's simple. It's getting a little bit more complex, but basically, as I already said, right? So you get, in addition to getting rewards or gas tokens, you get some voting rights. So basically, anyone can hold their tokens and earn rewards by running a node, which, again, trying to keep it simple, means that you have a dedicated amount. Typically, it's like 1,000 tokens. You can then run a node. And what a node does is, one, it will give you additional rewards. So like, let's say instead of like 5%, you're getting 5.5% a year or 6%. But what you also get is you get voting rights in the network. So now you're part of the community and you get to vote. And I'm sure that's probably way over what most people here care about. But it's definitely something to know about. From what all my research shows, the difference in rewards for just staking your tokens versus running a node is pretty negligible. So there's not a huge advantage there, other than if you did want to be voting in the governance of the coin, which, if you join your homeowners association or PTA, maybe you're that type of person. For me, I'm so busy, I don't have time to be voting on that stuff.
Okay, so to clarify things on the Neo side, as opposed to the Ethereum side of things, there currently is minimal incentive to actually stand up a Neo node and to build out the network.
Well, I didn't say that. So
okay.
I said what the incentives are. For me, I'm not incentivized by that. I'm not on my HOA. I'm not on my PTA. For some people, they like that. So if being involved in that, having voting rights, if that's important to you, then the incentive's there. For me, I'm not incentivized by that. But so we should clarify that.
Oh, okay. But if it was purely economic driven, to set up a Neo node is going to cost me X dollars. Let's say using US terms, it would cost me $10,000 or some number. Let's say $10,000 to set up and operate a Neo node. So
100,000.
Okay, 100,000. Okay, it's $100,000 to set up a Neo node versus, and if I put that money into setting up a Neo node, then I get to earn, for having my 1,000 Neo tokens, I get to earn I get a higher return on my gas than I would if I did not have a Neo node. Then on top of that, there is the operational side of the Neo node, but I should get some sort of return for processing the gas transactions or the Neo transactions in Neo gas. That's correct, right?
Yep.
So hopefully this is kind of putting the whole pieces together, and I'm not offering this for judgment purposes or anything like that. I'm just kind of laying things out so people understand, okay, when I'm buying Neo, I'm buying, beyond speculation, I buy Neo for the sake of hopefully aggregating enough Neo so then I can actually run a Neo node and then generate gas when the Neo network is fully in production, and I don't know if that's a year from now, 5 years from now, or 10 years from now on that front.
Yeah. So we're starting to see a huge shift to POS type coins. As a matter of fact, Ethereum is saying they're going to switch from a POW to a POS this year. So we're starting to see more and more of that. I like that. I think POS tokens are great from a bunch of different levels. One, it doesn't require all the resources of mining and electricity and whatnot. Two, I get a chance to earn dividends. I mean, in stocks, if you can earn dividend paying stocks, that's pretty awesome. So these are dividend paying cryptos. So I like that as well, so I like POS. And so anyway, Ethereum should probably be switching over to POS this year. Neo is, a bunch of coins are, and it's great.
Yeah, sorry about that. I had a little connection issue on that front. Okay, so ultimately though, if you think about this, isn't, going back to the NEO issue, isn't that a fundamental problem that may need to be solved with NEO? Because it seems like the incentive to hold NEO versus the incentive to build out a transaction node is a bit higher. Like, why would anyone build out a NEO node?
Well, I told you. So you can earn more rewards, and you have voting rights for the governance of the platform. Now, this is a much deeper conversation. Now we're only specifically talking about NEO, but all these coins are starting to set up their own POS systems. And so they're all different. And it's no different than stocks, right? Some stocks pay 3.5% dividends, some pay 4.5% dividends, and they all work a little bit differently. And these all work a little bit differently. So that's why it's a very surface conversation. But on NEO specifically, why would you want to own a NEO node? So you can earn a higher reward and you have voting power in the platform.
Correct. But going back, and I'm not disagreeing with you, and maybe I'm asking the same question, but the whole sell of NEO over Ethereum or something else is, if I want to start a blockchain, instead of me having to go place out, thousands of decentralized nodes out in the marketplace, getting people to set up mining facilities or mining nodes so I can process my transactions and run my blockchain, by building on top of NEO as some sort of decentralized app, I'm able to leverage the existing NEO network, and then I pay in gas or in NEO gas to run my application on top of the NEO network. So you've got a fundamental challenge where the NEO network, if everyone just sits there and holds tokens and doesn't run NEO nodes, the network is not going, the value of the network isn't there, because if I've got my app I want to write and I want to pick a network, I'm going to pick the network with the most, I'm going to pick a lot of things, but one of the things that I need to be mindful of is who's got nodes out there that can actually process transactions. Otherwise, I'd go build them myself, right? It's basically the fundamental build versus buy question that gets asked. Does that make sense, Mark? Are you following me?
Well, I guess you've kind of switched I don't know if you're switching conversations. I thought we were talking about it from like a consumer standpoint. Why would I want to own NEO or gas? And now it sounds like you're switching to like, why, if I was a blockchain developer, why would I want to build on the NEO platform?
Well,
those are obviously two much different questions with two different motives.
Well, they are, but they're related though, because if the consumer side, the way I see it is, if the consumer side of the NEO network is not set up properly, and consumers, decentralized users, which is what NEO is all about.
Well, I think I get what you're saying. So Charles, this is a very, 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 very fundamental question. This is socialism or capitalism. That's what you're talking about.
Mm-hmm.
You're talking about socialism or capitalism. I'm a capitalism guy. So to answer your question, I believe that the market will respond. If there's so many applications running on NEO that the gas is going to pay me more, I'm going to switch and I'm going to hold a NEO node. If the prices aren't there, if nobody's building on it and the volume is there, there's no market, I'm not going to do it. So money goes where it's treated best. That's always my thing. And so from a capitalism response, if the volume is built up, then the transaction fees are worth it for me to do that. The flip, you're talking about like socialism, like, well, who's going to pay for it if nobody wants it? Well, the answer is nobody.
Nobody. No.
Nobody's going to pay for it. If there's no reward, why would anybody pay for it? They won't. So it's a free market, and if they build this network up and they attract enough people, then the transaction fees will be there, and people will come in to support that. And if they don't, then they won't.
Correct. So this is going back, and the purpose is not to actually get into a debate about, does this need to happen? Does that not need to happen? But really to help people understand, what the heck am I buying when I'm buying NEO? What the heck am I buying when I'm buying gas? People say, hey, NEO is going to be worth $1 million or NEO won't be. I personally am very positive on NEO because I like how the dynamics work. But the purpose of this is just to kind of illustrate, when you're buying into a project, it's helpful. Well, you don't need to, I guess. People buy things for all sorts of reasons. But the way I am, I like to understand what I'm buying and also understand the interplay of the various aspects of how this stuff works, so that where my money's going, I can see, okay, let's see. So it's not just buying NEO. If I'm buying NEO, I probably need to keep my eye on gas, because if gas,
but then it goes, okay. So then it has to go a step deeper. So we've talked about this. We actually had a whole show dedicated on this with token mechanics. So gas is used to pay the transaction fees.
Mm-hmm.
That in itself, it could become the most widely used. It could become the most widely used application gas token in the entire world, but that in itself doesn't necessarily make it go up. So we want to have some sort of a mechanism that creates scarcity. And so why? I mean, as long as we're just constantly switching gas, that the velocity is too high, and that won't drive the price up. So we want scarcity. So that's where like a POS system comes into play, where with like NEO, for example, I'm going to want to hold NEO. I'm not going to want to sell it. And as more people want to hold it and not sell it, it creates scarcity, which then causes the supply to go up. So that's why if you see, like, I think Ethereum, and those types of coins where there's only one coin might be a better model, because not only is the coin needed for demand, but the supply is restricted. Whereas NEO actually has two separate ones for that. Whereas if NEO and gas were together, you would have the demand side, because of the gas transaction, and you'd have the supply side because of the staking.
No, again, that's another valid point, right? So like I said, we're just kind of peeling back the onion a little bit to help people get a glimpse of the fact that there are many moving parts in putting a token economy together.
But the reason why I like those is because they're a lot easier to understand. So for example, like with 1,000 NEO tokens staked, you'd make about a third of a gas token a day, and that's pretty good. So what happens is, as gas prices rise, I can tie that to a dollar amount. Gas is $10. I get a third of it a day. I get $3. $3 a day I get. That's whatever, $1,000 a year or whatever, right? And so now I'm like, okay, so for $1,000 a year, 10% return, I'm willing to pay 10 grand. I can pay 10 grand to make $1,000 a year, right? And so I can tie that back to a real dollar amount, and it changes it from like a speculative play to more of like an income type play. So a bunch of different pieces here. I mean, we can go round and round and round. I don't know what it really means. I guess at the end of the day, everybody's looking for something different, and they should, right? So I'm willing to have wild speculative plays and shoot for the fences, and it's nice to have some, safe revenue producing coins as well. But I think at the end of the day, the market is way too young and too fresh, and everything's pretty much speculative at this point.
Yeah, I mean, there's no question there is some level of speculation. It's just nice to know that you're speculating on something that has actually a plan that hypothetically could work out, instead of speculating for speculation's sake, right? Those are two different things.
Very different.
Cool. Well, wow, we've been on for about an hour again. Time flies when we're having fun. Absolutely. So want to thank everyone for tuning in again and listening to the three of us kind of geek it out on blockchain, fintech, fiscal policy, and all that sort of stuff. So thanks everyone for tuning in. Again, generally speaking, every Monday, if you guys haven't gotten the gist of it, we go live every Monday and just kind of talk about what's on our mind. So great tuning in. We hope to see you guys next week. And until then, be safe, be happy investing. Hopefully we'll start mooning again. Probably not this week. Well, let's ask predictions wise. Crystal ball. Do you think we're bouncing up? Are we bouncing down? Are we about to moon? What are your thoughts, Mark?
I mean, both Dr. V and I both strongly agree that it's impossible to time markets. So we've already put our stake in the ground on that. So we can't go back on that. So we already said it's impossible. What we do is we look at technical analysis to kind of tell us where we're at, and the technical analysis is inconclusive. Bitcoin needs to break above 9,300 to prove that we're in an uptrend.
Right.
And until that happens, we're not. I wouldn't be surprised to see us continue in this consolidation pattern for another month. It hasn't changed my outlook for the year, but the short term is impossible. So We haven't confirmed, the analysis hasn't given us a confirmation of a break to the upside yet. I wouldn't be surprised to see us kind of consolidating, trading sideways for another month. I'm hopeful that maybe, a 1 to 2 weeks will be all we'll need, and we'll start running again.
Cool. Alrighty, so sounds good. Well, again, thanks a lot, everyone, and let's tune in next week. Talk to you guys soon.
Take care, everybody.
Bye-bye.